Hello, good morning. It's Jeffrey Christian of CPM Group. It's about 10:55 here in New York on Wednesday, the 22nd of February. We're doing our video on Wednesday instead of Tuesday because we were just swamped with other work on Tuesday. So we're going to put this in. I want to talk about the gold and silver markets, where they are right now. Prices have been weaker than some people expected. They've been weaker than CPM Group expected, actually, by $20 in gold and maybe $1 in silver, and talk about what we see going on this year, next year in gold and silver, continuation of what we saw in the second, third, and fourth quarters of 2022. Talk a little bit about that. And then I want to talk about central bank gold and dollar practices, because there's a tremendous amount of misinformation about central bank activity, both with the dollar and with gold, circulating by gold promoters right now. I want to start by reviewing gold and silver price seasonality. Seasonality is important. It's not as important as macroeconomic and political factors, but it is an important factor, and you can see it oftentimes in the prices of metals. And here you can see the gold and silver price seasonality. January, February, and March tend to be strong months, the strongest months for gold and silver prices. There are fundamental reasons related to fabrication demand as well as investment demand that tend to cause this happen. Prices tend to weaken in the second and third quarters. They tend to pick up in September and the fourth quarter for gold, and not so much, but some for silver. And as again, there's fabrication demand, seasonal patterns, buying patterns, and there are also investment demand patterns that tend to be in there. And that's important because the seasonality has been important. It's not, and it's going to continue to be important. And it is one of the factors behind our price expectations over the rest of this year. It's not the most important factor. The most important factor is investment demand. And investment demand is flavored by economic and political developments. We'll get back to that in a second. Here you can see gold prices. They rose very sharply November, December, January. They have come off some from that, but they're trading, I think, around 1840, 1850 as we speak. CPM Group's expectation is that the gold price probably will trade between maybe 1780 on the low side. It could go lower. Could go as low as 1680 over the course of the second and third quarters. We don't necessarily see it going back as low as it has been. And on the high side, 1920, 1950. Prices fell. They rose very sharply in the first quarter. There were a number of last year. There were a number of factors. There was recession concerns, and what would that do to the stock market? And interest rates were rising, and we're going to go into a major recession. And would the Fed have to pivot? Inflation was high, and then Russia invaded Ukraine, and all of those factors conspired to bring gold up to $2,000. Got up to about $2,060, I think, on an intraday basis in early March. And then the price came off, and it came off through the second, third, and fourth quarters into early November. And that's very important when you come to talking about what the Chinese People's Bank of China has been doing with gold. And we'll get back to that. After November, the price started rising again. Silver, very similar pattern. Came down. It was very weak in the third quarter and into the fourth quarter. It started rising. Actually rose more forcefully in percentage terms in November and December than did gold. Kind of plateaued in January, and it's come back off now. Our expectation for both of these is that the price kind of plateaus over the from now through the third quarter of this year, and possibly start rising in the fourth quarter of this year or early 2024, depending on what's going on in the economy and what's going on politically, both within the United States domestically and globally. There are a variety of things that are developing. What we have seen over the last 9-10 months has been that investors have backed away from their fear of a recession. They've watched as inflation has started to decompress and rate increases in prices have been coming down for 7 months now. So inflation is a little bit less worrisome for a lot of mainstream investors. Recession is a little bit less worrisome. Interest rates have been rising more and more rapidly, and they're likely to stay higher longer than financial markets have been expecting or seeming to expect them to do. There's been no capitulation by the Fed and other central banks, and we can't control inflation. We have to worry about recession or depression. There's been none of that. So financial markets have backed away from the concerns that were driving them into precious metals. And just looking at investment demand, we've seen weakness over this period of time. Weak, but still strong. Investors are backing away from the concerns that they had, but those concerns haven't gone away. And other concerns have come up. So that's sort of where we are. Talking about investment demand, I said it's weaker, but still strong. In 2020, when the world locked down and we went into a very steep recession, you saw investors buy 40 million ounces of physical gold that year. 2021, as we were coming out of that lockdown and we saw very strong economic recovery, investors backed off. They bought about 26, 27 million ounces. They didn't go back to 16, 17 million ounces, which were their levels in 2018, 2019. But they bought maybe a third less gold than they had bought the year before. Bought a little bit more last year, mostly in the first quarter, and then we expect them to buy a little bit more again this year. 2024, we expect investment demand to be much stronger because we think the economic and political environment will be much more severe. Now, if you look at that investment demand on a intra-year basis, what you saw in India, in China, in North America, and the United States was very strong demand in the first quarter of 2022, and then weaker demand as the year progressed. And if you look at the China Gold Association's data on what happened with Chinese gold supply and demand last year, they have mine production and refined production from imported concentrates and scrap rising, and they give the tonnages and the percentage change from 2021 to 2022. When it gets to jewelry demand and investment demand, they say jewelry and investment demand were very strong in the first quarter, and then it were very, very weak in the second, third, and fourth quarters. And for the full year, they were down significantly. They don't quantify the significant declines they see or saw in jewelry demand and investment demand in China in the last 9 months of last year. Similar conditions were seen in India, the other major market for gold, in both used in jewelry and as an investment, and in North America and in Europe. One of the weird things that you did see was that investors were shifting in ETFs away from smaller ETFs to the larger, more liquid ETFs. That reflected a broader concern about the stability of smaller financial institutions on a worldwide basis. Similar trends were seen in silver. We saw a big increase in silver in demand in 2019, 2020, 2021. It backed off some last year. It's probably backing off a little bit more. But I want to point out, as the headline says here, surpluses reflect investment demand in silver because a surplus is defined as total supply less fabrication demand, and you don't include investment demand with fabrication demand if you want an accurate reading of what's going on in the market. The surpluses are reflecting investors wanting more silver and bidding up the price, bidding up increasing supply and bidding silver away from fabricators. We're seeing strong It's weaker than it was 2 years ago, but it's still strong demand. Investors have backed away from some of those fears. Let's look at central banks quickly. There are a number of, as I said, misrepresentations going on. This is the back half of a chart that we have in our precious metals advisory every year, and it will appear a table in our gold yearbook, which will be released at the end of March. These are the 9 countries that were selling gold last year, and you can see the total was about 2.5 million ounces, and well over half of that was Kazakhstan. Kazakhstan had an attempted revolution, 2020, 2021. Russia had to send in troops to quell the revolution and protect the government buildings from people who wanted to overthrow the government. And then in 2022, Kazakhstan suffered from the fact that its major trading counterpart is Russia. And with the Russian invasion and the subsequent sanctions on Russia and the Russian economic problems that you saw, Kazakhstan also had these problems. So Kazakhstan had been a buyer of quite a bit of gold from 2009 or so until 2020. And last year they sold about 1.6 million ounces. If you take them out, you see very small purchase sales. And it's 9 countries. The total at the bottom, 9.6 million ounces, is these sales and these purchases. Last year, 21 countries bought gold. That was an increase in the number of countries. But if you look at it, I've highlighted in red and in pink, India. In red, I've highlighted Islamic countries. And you can see several countries. China bought 2 million ounces, November and December. Turkey, 2.5. Egypt, Qatar, Iraq, Uzbekistan, we count it as an Islamic country. And the UAE. Interestingly, the UAE sold some of its gold in December. It had added 788,000 ounces through November, and it sold about 150,000 ounces in December. After that, you can look and you can see we're looking into Argentina. There may be a change that we're going to have there, but much smaller purchases. And a lot of these, 10,000 ounces, 9,000 ounces, that's probably gold that was purchased for commemorative gold coin programs by the central banks. So 12 million ounces on a gross basis, 9.6 million ounces purchases on the net basis. And of the major purchasers, China in the last 2 months of the year, India, where Muslims play a very significant role in the gold and silver markets, and 6 Islamic countries. So insofar as central banks are rushing into buying gold, it's primarily Islamic countries. So when people are telling you got to buy gold because central banks are buying gold hand over fist, it's half a dozen Islamic countries. And you have to ask yourself what's going on in terms of domestic politics and economics in those countries that they've been buying gold like this, because that's really what's important. Yeah. Central banks are not dumping the dollar. These are foreign exchange holdings of central banks in monetary reserves. And you can see they've been pretty much flat. So central banks aren't dumping the dollar, and fiat currencies aren't collapsing. I don't even know what it would mean for fiat currencies to collapse, but I see gold promoters who have been wrong for decades, pretty superficial kind of guys, talking about that. There's another conversation that's going on about how the BRICS are discussing a gold-backed currency that would be the currency issued by Russia, China, India, Russia, Brazil, China, India, and South Africa. And it's very interesting because you hear the gold promoters talk about this, but you do not hear any central banker, any government official, any mainstream economist. You don't hear them talking about this, You don't hear them writing about it, see them writing about it. You don't hear them discussing it in each of those 5 countries. Putin has talked about how they're buying gold because they were afraid of sanctions being imposed upon them once they attacked their neighbors. But Putin has talked about buying gold and adding it to his reserves. He's talked about the idea of a gold-backed ruble. But no one in the Russian central bank is talking about that except when they have to kowtow to Putin. And no one in China and India and Brazil and South Africa are talking about that. In fact, when you talk to people in some of those central banks, they don't even know that it's an issue because they don't sit there and listen to what the gold promoters on the internet say. They're busy with their work. So no one is really discussing a gold-backed BRICS currency and dumping the dollar. Now, China, I've already gone longer than I wanted to. One of the things that people don't seem to understand is that many central banks will act as agents in the gold market and in some cases the silver market for other entities within their country, either government agencies or private corporations and banks that want to trade gold. And they say, well, we're a central bank and we have a guy who knows how to trade gold, buy it, sell it. And People's Bank of China does that. They used to be the market maker, and you had to buy and sell your gold and silver through the People's Bank of China or its agent commercial banks until 2001. They got out of that business. 2001, they transferred and when you do that, you have monetary reserves and then you have trading stocks. And the trading stocks represent this agency business, and you don't add that in with your monetary reserves because it's not your monetary reserves, and it fluctuates as people ask you to buy and sell for them. So you keep it as a side bucket. And in 2001, China got out of the market-making business, and it transferred several million ounces from that special trading account into its monetary reserve. One of the things you hear is that China hasn't reported its gold inventories since 2019. That's not true. China has been reporting its gold monetary reserves every month all along, 2020, 2021, 2022. What they've been reporting is that they weren't buying. They stopped buying after 2019, actually earlier. Why did they stop buying? The price had been $1,240 to $1,350, and they were buying. In late 2019, early 2020, the price of gold started rising. It got over $1,400. It went to $1,600, then $1,800, and then $1,900, and then $2,000 an ounce. And in that kind of environment, the People's Bank of China said, hey, we're not buyers. We are value investors. We buy low, and we try not to buy high. In 2022, the gold market saw weaker demand in China from jewelry manufacturers, jewelry buyers, and investors. Gold started being sold. Chinese government says, we don't want that gold leaving China. So if you're taking in gold from Chinese sellers, find Chinese buyers for it. And over the course of those 3 quarters, it was hard to find buyers in China for all of the gold that was being sold by institutional investors and by jewelry manufacturers who didn't need as much gold. So it was showing up in the side pocket, the trading inventories. And some people said, well, that must be central bank buying. Well, it is central bank buying, but it's central bank agency buying. Now, on November 3rd, the price of gold got down to $1,630 or $1,624. And people at the People's Bank of China said, hey, the price is not $2,000. It's not $1,800. It's $1,624. And we think that this may be close to the bottom. We had thought that maybe the price would stop at $1,680, but it's actually $60 less than that. So let's take 1 million ounces of that gold that's built up in our trading inventories and buy it ourselves and add it to our monetary reserves. And they did in November. And in December, the price was starting to rise. They bought another 1 million ounces. And it looks like they bought another 1.5 million ounces in January. That's where that gold is coming from. It's not that they bought 10 million ounces and that central bank gold purchases on a net basis were 20 million ounces, not 10 million ounces. It's that they bought gold. They didn't buy gold. They were bringing it into their trading stocks, trying to find buyers within China, and they couldn't find it. That's a lot less bearish story than, oh my God, central banks bought twice as much gold as they have been in recent years last year. You can read about us. We will be having a silver seminar online next Wednesday. You can go online and search for CPM Group's videos. I was going to put a page in here on this and I forgot. I apologize. You can find our silver webinar next Wednesday. We probably won't do a video on Tuesday since we're doing the silver webinar on Wednesday, but we will try to do a video on Friday, and we'll put the links on that there, and we'll try to get the links here when we post this one. You can go to our website and learn more about that. You can pre-order our yearbooks. The gold yearbook will come out at the end of March, the silver yearbook at the end of April. They contain accurate information and analysis and statistics on precious metals. Thank you. Have a good day.